Taxes are the lifeblood of any modern society. They fund essential public services that we all rely on, from education and healthcare to infrastructure and defense. Without taxes, our governments would be unable to function effectively, and our quality of life would suffer dramatically. Taxes ensure that everyone contributes to the common good, creating a fairer and more equitable society. They allow us to invest in our future, supporting research and innovation that drive progress. However, the effectiveness of any tax system hinges on its fairness and the compliance of taxpayers. When individuals and corporations exploit loopholes and engage in aggressive tax avoidance, it undermines the integrity of the system and places a disproportionate burden on honest taxpayers. Financial engineering, in its simplest form, involves using complex financial transactions to achieve specific outcomes. While not inherently bad, it often carries negative connotations, especially when used to manipulate financial statements and reduce tax liabilities. Think of it like building a complex machine, not to create something useful, but to exploit loopholes in a system. Companies engaging in financial engineering often exploit differences in tax regulations across various jurisdictions, shifting profits to low-tax havens and minimizing their overall tax burden. To understand how financial engineering works, let's look at some basic accounting principles. The fundamental accounting equation states, assets equal liabilities plus equity. This simple equation underpins the entire financial system. It tells us that a company's resources or assets are either funded by borrowing, known as liabilities, or by owners' investments, which we call equity. Another important concept is the debit-credit mechanism. Every financial transaction involves a debit, which is an increase in assets or a decrease in liabilities, and a credit, which is a decrease in assets or an increase in liabilities. This system ensures that the accounting equation always remains balanced. Financial engineering often involves exploiting the complexities of tax laws and accounting standards. Companies use intricate corporate structures, transfer pricing arrangements, and complex financial instruments to shift profits and minimize taxes. For instance, a multinational corporation might set up a subsidiary in a low-tax jurisdiction and then route its profits through that subsidiary, even though the actual economic activity occurs elsewhere. Another common tactic is to use transfer pricing, where goods and services are transferred between subsidiaries of the same company at inflated or deflated prices to shift profits to low-tax jurisdictions. The consequences of widespread tax avoidance are significant. When corporations shirk their tax responsibilities, it reduces government revenue, impacting funding for essential public services. This can lead to cuts in healthcare, education, and infrastructure, ultimately harming the citizens these services are meant to benefit. Moreover, tax avoidance erodes public trust in the fairness of the tax system. When ordinary citizens see large corporations avoiding taxes while they struggle to meet their own tax obligations, it breeds resentment and undermines the social contract. Combating tax avoidance requires a multi-pronged approach. Governments need to close loopholes and strengthen tax laws to prevent companies from exploiting them. International cooperation is also crucial to address cross-border tax avoidance. Harmonizing tax regulations and sharing information between countries can help to level the playing field and prevent profit shifting. Furthermore, promoting tax transparency and requiring companies to disclose more information about their tax affairs can deter aggressive tax avoidance and increase accountability. Technology is playing an increasingly important role in tax compliance. Governments are leveraging data analytics and artificial intelligence to identify potential tax avoidance schemes and improve their audit capabilities. Real-time data sharing and digital tax administration systems can streamline tax collection and reduce opportunities for evasion. For taxpayers, technology can simplify tax filing processes and provide greater transparency. Online platforms and mobile apps can help individuals and businesses manage their tax obligations more efficiently. Beyond legal obligations, corporations also have a moral responsibility to pay their fair share of taxes. Engaging in ethical financial practices builds trust with stakeholders and contributes to a more just and equitable society. Companies should prioritize transparency and accountability in their tax affairs, disclosing relevant information to investors and the public. By promoting a culture of ethical financial practices, corporations can play a positive role in shaping a more responsible and sustainable business environment. Tax avoidance through financial engineering poses a significant challenge to modern economies. It undermines the fairness and integrity of tax systems, deprives governments of essential revenue, and erodes public trust. Addressing this issue requires a concerted effort from policymakers, tax authorities, and corporations alike. By closing loopholes, strengthening enforcement, promoting transparency, and fostering ethical financial practices, we can create a fairer and more equitable tax system that benefits everyone.